second inning. It's going to be a long game.
That was the right question. You started the show last night. You asked Tim, how do you read these CPI? If I had told you numbers, we'd be able to tell you where the stock market's going to go. And Tim was, Tim said probably not, maybe. And I'll tell you, if you had told me the numbers that came out this morning, S&P's down 75 handles, easy, given what the expectations were and given the run-up we've had. S&P closed unchanged. But what we just talked about for the last 10 minutes or so, that's not going to do anything to help the inflation problem that I think we're still in the midst of. And all these rate cuts seemingly priced into the market, I don't know. I think people are getting ahead of their skis a little bit.
I mean, if we thought it was sticky, it could be even stickier given the increased shipping costs.
Well, and again, the market's playing like we're in the bottom of the eighth or top of the ninth in terms of their Fed policy. And so not bottom of the ninth, but and I like this metaphor, by the way. It's nice. I think we need to continue it throughout the show. But I think, as Guy said, that CPI number, it doesn't necessarily change the Fed. It does tell you that the Fed is nowhere near cutting. I mean, in some sense, I don't think that the Fed has told us that they were near cutting. You also had jobless claims number. Look, a 4-week moving average on this means there's zero movement in the job market. Joblessness is not increasing in this country in a meaningful way. And all of this means that inflation is a lot stickier. Basically, today's CPI says we're not. Also, you talk about the early in the game. CPI at 3.3, 3.4 on core is still very far away from the Fed getting to 2%.
Housing costs are really sticky and moving higher at this point. Insurance, very high, in terms of costs. And then now we have these additional costs that have not yet gone through to prices.
Right. No, it's the first thing I thought of as well, listening to him talk, was about, OK, this is not good for what we've seen is a reversal in the supply chain issues that have come up for the past 2 years. And that has provided a really nice tailwind as companies have been able to say our landed goods cost is better, so our gross margins are much better. Now, if this reverses all that, that isn't good. And then, I don't know, I would expect to see increased volatility as well, which isn't generally good.
Yeah, it brings us, though, to 2 years ago, like this week, when tanks started rolling or amassing on the Ukrainian border from Russia, right? We started to see natural gas. We started to see crude oil prices kind of work higher, and we had that big spike. And they make no mistake about it. I mean, that situation and that short-term situation and the unknown about how long that war would last, what the disruptions would look like, it caused a huge spike. And I think it definitely made much worse the inflation situation at the time, especially when a lot of folks were expecting that the supply chain disruptions from COVID were getting better at that time. But here we are 2 years later, right? And we have gas, at the pump, $3 nationally. We have crude oil, right, at $71 or something, can't get out of its own way, down from 95, despite a lot of these geopolitics issues. So, I mean, to me, I think that, like, the near term, we're going to see all these charts about the Baltic Dry, and we're going to see all these shipping rates, and they're going to go up, and then we get used to it, and then we work it back in. But again, if these sorts of disruptions to manufacturing and supply chains, if they're real, like, who knows? The second inning of this stuff, I don't know. Like, we just dealt with a global pandemic a few years ago, and we got through it, and everything seems to be going okay.
I do think that the U.S. is somewhat isolated, certainly relative to some other countries, from this being and it sort of reinforces the onshoring idea or nearshoring.
Which is inflationary.
All inflationary.
But stickier inflation in other parts of the world might be even a bigger challenge for those central banks as opposed to where we are in terms of our own economic data, which is much stronger than other countries.
I think that's right. And I look, there's no question that we have a very tenuous, complex geopolitical situation in the Middle East. And for equities, I'm fortunate enough to be asked to be part of the Merrill Lynch Bank of America Fund Manager Survey. When they give you 4 or 5 listings of what your biggest concerns are for 2024, it's everything from the Federal Reserve to a credit crisis. But where people are clicking on more than anything is geopolitics. It's certainly where I'm clicking. So when you think about the discount,
this, do you think, or China, or
yes, and yes.
Oh, yeah.
Okay, because there's no question we have Taiwanese elections, we have elections here, we have elections around the world, but we have the horrors of what are going on in the Middle East, and I just think it's a case where the risks go up. It also reinforces the energy security trade. It's great for gold. It's great for uranium. I mean, some of these trades are things to think about. It's also, if it really gets ugly, it's a dollar flight to quality story, which isn't good for equity. So there's a lot to do here.
That's exactly right. Will it be a flight to quality in the form of the dollar, making the dollar go higher, and in the bond, making yields go lower? Because yields should have been markedly higher today, I think, given those numbers we saw this morning. And they were muted, and maybe that bond auction at 1 o'clock did something to mitigate that. But it's the cross currents are tremendous. And that Taiwan election's a big deal that nobody seems to want to talk about. But, with all eyes being on the Middle East right now, all eyes are being taken off what's going on, continued between, well, I don't want to say between, but the rhetoric out of China.